Hello, everybody. Lovely to have you all present at our webinar. We're very excited about today. Phia van der Spuy is going to be our speaker. I would like to introduce her, but today's topic is buying a property in a trust. All your questions answered. I think it's a very relevant topic because most of us are in the property industry, and I often get clients coming to my office and say they want to buy a property and they want to register it in a trust. And my first question is always why? And then the standard answer is because somebody said it's a good idea. It might be a good idea, but you need to do your homework on that. So our speaker today, as you can see on the left-hand side, that's the book, Demystifying Trusts in South Africa. Phia van der Spuy is the author of that. Phia is a chartered accountant with a master's degree in local and international tax, a registered fiduciary practitioner in South Africa. She's a master tax practitioner, a trust and estate practitioner, and the founder of Trustees, a professional trust practitioner. She also holds a BCom honors degree in industry psychology. I mean, I think I don't think we could have got a better speaker than Phia today. Sort of move this thing. Phia is the co-founder of a company that digitized trust administration and accounting called Trustees. Phia writes about trust and estate planning in various national newspapers on a regular basis to educate and enlighten estate owners. She speaks at various conferences, radio programs, television programs, professional bodies, etc., etc. And Phia has received the FISA, that's the Fiduciary Institute of Southern Africa Chairman's Award in 2020 for a contribution to the fiduciary industry. Right at the last page, just some house rules. You can ask questions on the chat box, which we will post to Phia, and she will answer that. Right at the last, once Phia is finished, we will give you a chance to ask questions as well if you want to. And the last page of this presentation will be Phia's contact details. Then you can take that down and chat to her or speak to her via email, etc. Phia, thank you. Thank you for joining us. We're excited about what you're going to share with us, and it's over to you.
Right. Good morning, everyone. Thanks for the invite, Jan. Indeed, a very interesting topic to talk about, and a very practical one. And the audience today, I'm sure, have a lot more to do with trust than what one realizes. And it is also very relevant to have trust discussions, for the audience, where it's necessary. When you have a look at the media in the last number of years, a lot of them saying trust, the writing is on the wall, trust no longer serve a purpose. A lot of people made a lot of money to structure, people's wealth out of trust back into their personal names. Very interesting statistic, just for the first 6 months of the year, already 5,000 new trusts have been registered. So I believe a trust, if it's done correctly, still serves a purpose today. And fortunately or unfortunately, a lot of clients that you would deal with have existing trusts. And I think that is where the issue sits. Because most of those trusts have never been kept up to date, and is really problematic, when we try and regularize them and when we are looking to do property transactions in them. So yeah, let's have a very practical discussion. I'm going to try and keep it really at a level where we can all understand without boring you. So, and I know I said to Jan, everybody has got Zoom fatigue, so let's try not do this as a very boring session where most of the people kind of disengage after 10 minutes. So a good starting point is, what is a trust? And I think because a lot of people in South Africa especially do not understand how unique a trust is and trip over, treating a trust as a separate entity, although it doesn't have a legal personality. The court said a trust is they really can't define it. The trust is a contract. That's kind of the best the courts could come up with. And then obviously, because a trust is a contract, for inter vivos trust, that's a trust that you registered during your lifetime. that is a contract. So we always have to go back to the trust deed. And I sound like a gramophone when people ask me, can a property be purchased in a trust? What are the trustees supposed to do? I say, go and read the trust deed. The trust deed as the contract can stipulate very specific things that the trustees can do, can't do, processes they have to follow. And if you acting outside of that constitutive document, being the trust deed, your actions will be null and void. So it is critical to understand, that a trust is a separate thing. A lot of people try to compare it to companies. It is treated as a separate entity like a company, but a trust is run by resolution. And I think that is the big distinguisher. And that comes back to paperwork. Is there paperwork to back up what you want to do? Are you acting in terms of that constitutive document being the trust deed? So a trust, also has to be registered with SARS. So it's a very unique animal we are working with. The trustees, in most family trusts, where we call them ownership trusts, they own the property, including the fixed property, in a capacity as a trustee for the benefit of beneficiaries. And that, we'll speak about that later, that drives how trustees have to work together, how decisions are made. Can we exclude the minority? Do all the trustees have to sign? So I think as long as you understand that a trust is a very different animal, because a inter vivos trust, which you can register during your lifetime, you look at the trust deed. That is going to be your starting point when you start looking at property transactions. And we'll speak about later, because a trust, there's a lot of abuse, and it's not a company where the board of directors can be held responsible. The courts have been, gotten sick and tired of the abuse. When you just look at, for example, the financial institutions, the banks, there are a number of court cases. And I want to use a specific court case, practically during today to illustrate a couple of points, and you can go and read that. I think the market that you're working in, it's an absolute comedy of errors. It's the Brits case, that the Brits family have tried to take F&B for a ride, and they really got punched on the noses. So it's a comedy of errors. When you read that, it's so typical of our family trust in South Africa. So they just disregarded the trust deed. They treated the assets as if they just belonged to themselves. Their home, their primary residence was in a trust. So very important to understand that. So that's the inter vivos trust, which is most of our trusts, and you probably do your transactions in those trusts. The other type of a trust is obviously a testamentary trust that gets created in your will, and that obviously will only become created upon your death. And the will would form the trust instrument, similar to our trust deed that we would have when we create a trust during our lifetime. So I hope that sets the scene in terms of what a unique animal we are working with, and how it can be abused and is abused in some instances, and where the potential risk areas lie. Okay, we can have a look at the next slide. So what is the IT number of a trust? That is also a very important question, because we don't reserve a name for the trust when we want to register a trust like we do for companies. So there's not a unique name for a trust. Literally, it can be thousands of trusts with exactly the same name. The master doesn't stop you to register a trust where there's already exactly the same name being used. That's the first complication. So we would have to look at the unique number that the master's office give to register this trust. So we can change a trust name. Often the trustees say we can change the trust name. The IT number will always be the same. And because we're sitting with around about 15 master's offices, every master's office starts every year with a number 1. So you typically see a trust registration numbers IT 0001/2022. So every of the 15 master's offices starts with number 1. So now you see, apart from the fact that, trust can have more, more than one trust can have exactly the same name. It could potentially, in the old days, also have exactly the same number, because the master's offices start with number 1 of 2000 and 2022, for example. Now they've started adding a reference at the back of that number. So, for example, Johannesburg's numbers would be, in brackets G. So that is the unique identifier for a trust. So that could never change, during the life of the trust. Okay, we can go to the next slide. Is it a good idea to buy a property in a trust? Wow, that is quite a mouthful, and I think, it covers a lot of the further slides. My blanket answer when people ask me this question, I say it all depends. It all depends on a number of factors, which we'll discuss later on. Basically, every purchase is unique. There's no one vanilla answer to it is yes because of these reasons, or it is no because of these reasons. A number of factors drive it. Biggest thing is personal circumstances. Number one, is the intention to keep a property for the long term, because a trust is not an overnight kind of a decision. It's also not great because we know what the costs are, the transfer duties, the transfer costs just to move a property around. So this is typically not something you want to change your mind, about every now and again. Once it's in a trust, or once it's in a company, or once it's in your name, you potentially want to keep it there for the long run, because it's going to trigger all those costs, plus capital gains tax now if you want to move it. So if I change my mind later on and say, I want to move it out of the trust, triggers all those costs over again. So we don't want that. So intention, family circumstances is a question to ask. The second question to ask is, what is the type of a property? We see that types of properties, could also impact our decision as to does it make sense to have it in a trust, yes or no. And we'll have a look later. There are certain tax consequences depending on whether you keep a primary residence in a trust versus in your personal name. Then tax, always is a consideration. I always say to people, it's not only about taxes. I think a lot of the media exposure recently, trust the tax, the writing is on the wall. That had a lot to do with, SARS and the Davis Committee scratching around, not so, by the way, just with trust, for the high net worth individuals. That is the focus. It's not trust that is the problem. Unfortunately, trusts were abused in the past. So I think a lot of SARS's attention is, I am sure something is going on in these trusts that, could generate us money, or it's been hidden away from us. Tax is not the only consideration. For example, we have a business owner starting up a trust or starting a business, and they now want to acquire primary residence. They typically want to keep that away from any business risk that they as entrepreneurs may run. So it may make then sense to protect that asset in a trust. So just generally speaking, a trust, one does it for asset protection if it's structured correctly. And we'll have a look at it later. The moment there's loans from you to the trust, still exposed, you don't tick that box to protect that asset, away from your personal risk. So continuity, a trust that we will speak later about, it continues the next day, whether something happens to a beneficiary, when something happens to a trustee, when something happens to the founder, it creates that continuity. One can also create liquidity in a trust to make sure that, once, for example, the estate planner passes away, there may be access to cash because estates get frozen. So it may make sense to have, a little bit of a kitty in a trust, which is managed separately from your personal estate. The last good reason to have a trust still is taxes, funny enough. So I'm not going to get technical today, but a trust, you still have the ability to structure affairs legally to make use of the benefits unique to a trust. For example, you may have heard of the conduit principle. So we can make use of the conduit principle to move the tax liability out of the trust, which is a high tax paying entity compared to others, which we'll do a comparison now between different taxpayers. So you can move that tax liability to individuals who potentially pay no tax or tax at a very low level. Because remember, in South Africa, we have the sliding scale for taxes. So the more income you earn, the higher tax percentage you pay, which I think is a disincentive to work hard, but I mean, that's a discussion for another day. So potentially we may have individuals such as minor children, studying students, even beneficiaries still earn income at a very low level. So there is still this benefit available. It's not been taken away. And then you can also structure it, when we actually do these transactions, making loans to a trust, to use the attribution rules. If you just want to make a note there somewhere, this is technical stuff for tax experts to look at, but the attribution rules can still be used to effectively tax the person who makes the loan to the trust instead of that being taxed in a trust. So it may make sense, the long answer to the short question. So let's explore a little bit more on the next slides. What are the advantages or disadvantages of buying a property in a trust? Now, that's obviously what you want to consider when you look at, as I said previously, a unique individual case. There's not a one size fits all. So I think that's where a lot of people get it wrong. They want to generalize and say, does it make sense to have a property in the trust? What are the advantages? What are the disadvantages? Every property especially is unique. And as I mentioned, those factors that you have to consider before you get to an answer as to, does it make sense? So the advantages we have briefly discussed. It gives you asset protection. Caveat, if it is structured correctly, there's not a loan from the estate planner into the trust, because then we don't have that asset protection until that loan is repaid, because that is an asset in your estate. So if you get sequestrated, the liquidator would literally have to liquidate that asset, being the loan, and can penetrate the trust. So it is very relevant where we speak about property, and especially when we speak about primary residences. Now, if we have a paid up asset and now we've been told it's a good idea to move a property into a trust, that paid up asset, remember, the new trust doesn't have its own money to buy it from the estate planner. It's mostly on loan basis and 100% of the asset, because it is fully paid up. If we are looking to purchase a new property, whether it is a primary residence or a commercial property, and we are going to access funding, then it may make sense to transfer or buy it in the trust, because at least we break that link to have the asset protected. We may have to pay, for example, a deposit on the purchase of the property, but then we can just repay that loan pretty quickly, best we can, by using, for example, your 100,000 Rand annual donation allowance that is tax-free per person. So per couple, you can work that deposit loan down over not too many years. So asset protection, main benefit, creates liquidity, creates continuity, especially if we buy now a family home. So that is a very good asset for me if the intention is to keep it long-term for various beneficiaries to have use thereof. To consider, that advantage, that continuity advantage. The liquidity, if we, for example, have a commercial property, we can build up cash over time to, have access to, when estates get frozen upon death. Taxes, there is an advantage. If, for example, we are going to buy a commercial property or a piece of land that we are going to develop, and there's going to be massive growth in this development, you can see we still access that estate duty advantage by having all the growth happening in the trust instead of in a personal estate. So tax advantages there are, and obviously by using the conduit principle, if we, for example, buy income producing property. The disadvantages, I want to jump in straight away with a primary residence, because I think that's would be a lot of the property transactions that people would want to consider using a trust. Straight away, you are losing the 2 million Rand capital gains tax abatement if you had that property in your personal name. So when you sell the property and there's going to be a massive capital gain, the first 2 million is obviously excluded from that capital gain calculation. In a trust, you lose that because it's an entity, whether it was held in a company or in a trust, you lose that 2 million Rand. However, and I call it a new tax, but it is pretty old, 2017, SARS introduced a new legislation, Section 7C, which I'm sure you have heard about. That's where they are attacking these interest-free loans now. Because in the old days, if you transferred a farm into a trust and you transferred that at R1 million, that loan account, people said, never repay the loan, leave it. It makes no difference. So we do that, we transfer it on a loan account. 50 years later, the estate planner passes away. Now that 1,000 rand farm now grew to 10 million rand. Can you see that SARS, got irritated about the growth in the trust, up to 10 million, which they couldn't now include in the person's estate, because the only asset left in his estate is that R1 million loan, which was created 50 years ago. So that is Section 7C. SARS have been trying for a number of years to penetrate growth that happens in the trust, which was pegged or frozen, in the old days. So they have very cleverly now got a way to tax annual growth in the trust. And funny enough, they assume a growth rate of the official rate, and that's very relevant. So if you buy a property, and we are at the tax conversation now, I am saying, just to answer the tax question, does it make sense from a tax perspective? You should only put any property in a trust if it grows above the official rate. Now, that is a repo rate plus 1%. That's obviously a varying rate, so be mindful how that can vary over time. But SARS assumes that growth happens in the trust, on that property, and it taxes you annually. So instead of waiting till one day when they can access, the estate duty on the growth of that asset, that 10 million in my example, they are taxing you every year. So you are actually prepaying death taxes every year now. And the assumption is we assume the growth of that property is at the official rate. So in our market today, if it's a tax argument only, remember, it's not only about taxes, but be mindful. SARS assumes there's a growth every year. So that is obviously relevant for property, but SARS has been very nice to us. So because we lose that 2 million rand abatement, the capital gains tax abatement, they have said now that primary residences held in trust are excluded from Section 7C. So that is the good news. So at least from our primary residence, but you have to live there the whole year, every year, to qualify for that exemption. So don't think you're going to get away with a family home. You have to live there as your primary residence for that period. Then they actually exclude Section 7C. So if I had a primary residence, fully paid up, I'm transferring it into the trust on loan account, SARS exclude, or it's exempted from that new tax by taxing an assumed growth every year. So that's very good news for primary residences only. So I buy a second home to rent out, or I buy commercial property, that is not excluded. So if I'm buying a commercial property, I need to take that into consideration, that SARS is going to assume a growth. If I buy a bare piece of land and I'm going to develop and it's going to shoot the lights out, it's going to be a massive increase compared to my annual official rate, which is now 5%. Then, so one needs to do that calculation from a tax point of view. So, other disadvantages, a lot of people don't want to lose control over their assets. And this F&B case where they've been advised you are developers, so move away all your personal assets into a trust, then we hide them here. It's not going to be, so if you go under as a developer, it's not going to be affected. Unfortunately, they didn't give up control over assets. That is the bare minimum requirement of a trust. The court said we need separation between ownership of assets, which is in the hands of the trustees for the benefit of beneficiaries. So the separation between control and ownership from enjoyment. So a lot of people, because they found as trustees beneficiaries, they just can't help themselves. They cannot relinquish control. So if you don't relinquish control, or you're not prepared to do that, do not register trust and transfer. Even if it's a primary residence, even if it's your home, you have to relinquish control to the board of trustees. Now that's normally the mother, the father, and now we need an independent trustee as well. So the independent trustee has a say equal to all the other trustees, have to participate in trust decisions because they are joint owners of all these trust properties. So a very important, aspect to discuss with your client, are you prepared to give up and relinquish control over the assets that we are going to transfer into a trust now? And then obviously there are costs. It does cost money to maintain and set up a structure. So one has to be very mindful of those costs. Okay, I think that's enough on this slide. So let's move to the next one. Yes, so the FNB case is an absolute prime example to look at what families do. The trust doesn't have its own money when we set up a new trust. So often, if the trust buys the property from the estate planner, there's obviously going to be a loan directly to the estate owner because the trust doesn't have its own money. And that comes with the consequences we've discussed. And normally that loan is not repaid. If we have a bond in the trust and we manage to secure a bond to buy a property, then the trust still doesn't have the money to pay these, monthly installments. So often the estate planner pays it. Now, comedy of errors, what happened in the FNB case, they didn't even have a bank account. Now that demonstrates every trust has to have its own bank account. It's by law. Section 10 of the Trust Property Control Act says every trust shall have its own bank account, receive all money on behalf of the trust in this bank account. And so, by the way, that includes that little R100 upfront donation that the founders normally make in terms of the trust deed. So now we set up the trust. Hopefully we've got the bank account. Most of the times that's not even the case. And in the FNB case, they didn't even have a bank account. So the founder should at least demonstrate that the trust exists, transfer the money into the bank account, let the bond, the debit orders go off, from the trust bank account. They just paid it directly, right? Demonstrating that it's not, they don't treat it as a trust. So the courts did look right through the trust and disregarded it and ignored it. And basically, as part of the sequestration, included the trust assets in the sequestration. So you should never pay directly into the bank's account. The correct procedure is transfer the necessary cash into the trust bank account, let the trust pay it, not directly. Even if you do that, whether you pay directly or whether you pay through the trust, that the money actually borrows that money from you to make those payments. So exactly the same principle applies from a estate duty point of view. That asset increases, that loan account increases, so that is going to be an estate upon your asset in your estate upon your death. Secondly, if we try to buy it in a trust to get away from creditors, that loan account grows now, so I do not get the asset protection that I needed by purchasing the asset in the trust. So from an asset protection point of view and exposure point of view, not great. If it's not my primary residence, that is also going to be problematic. And just while we're on it, just want to make sure Section 7C only speaks about the exemption for the acquisition of a new property. SARS hasn't come out and give clarity about how about if we make improvements to this property now. Is that also exempted? Because it's just for the acquisition of a primary residence. So, the jury is out, and it remains to be seen. But be very mindful if the trustee or the estate planner pays the bond on behalf of the trust because the trust doesn't have money. Don't get the protection. Section 7C is potentially an issue.
This is right.
And that is going to be an asset in your estate. So at least what you should do is use that 100,000 Rand annual donations tax exemption to work down that loan, or annually donate the 100,000 between two spouses, 200,000. So depending what size of a house you bought, if that could cover, most of the bond repayments, that would be good planning. Okay, next slide. What are the consequences if a trustee uses his own money to buy a property in the trust? I think I have pretty much explained this by now. So if you buy a property in the trust and you're not getting a bond, straight away with that big fat loan because the trustee gives money to the trust for the trust to go and buy the property. So just very briefly, that is now exposed from an asset protection point of view because the loan is into the trust. And the liquidator may liquidate the trust assets to have that loan repaid upon death. Also upon death, remember that's an asset in the estate, depending on how that should be treated in terms of the will. You know, the executor may even have to liquidate the trust. So very important to have a look at the terms of that loan and then the agreement between the estate planner and the trust in terms of what happens, you know, upon death. So Section 7C, relevant here because, you know, Section 7C may apply if it's not your primary residence. So yeah, just be mindful when you use your own funds to buy the property. Okay, can trustees sign surety when buying a property in a trust? Well, I'm sure you deal with banks every day. They take everything from everybody. So of course they are going to ask the trustees, even the beneficiaries, even the founder, to tick, you know, those boxes and sign surety, because in most instances the trust is an empty shell. It does not have value. So the banks are a little bit nervous. And the fact that, you know, the trust doesn't have its own money. So they know the money they're going to rely for repayment from somebody else. And it's typically that somebody else that they are going to ask, you know, to sign sureties. So, you know, if, for example, you buy the property in a company, and the company is held by the trust, because that may be good structuring from a tax perspective to add that extra layer. For example, a commercial property, it may make sense, let a company buy the property, but still protect the value of the company, you know, through the shareholding being held by the trust. Then I'm saying to people, try and resist for the bank to take surety, you know, from the company, because that's where you want to protect this asset. And obviously if the bank has got sureties, they can, you know, call on their surety. So unfortunately the banks, you know, take everything from everybody, so they can ask the trustees. Normally the independent trustee is not going to sign surety, right? So the banks would take, you know, surety from where they would get comfort that their loan would be repaid. Okay, next slide. Okay, so difference between personal tax and tax on a trust. So I have started talking about the conduit principle. So just important to understand the taxes that you pay in a trust versus what you pay on an individual. There is still a difference. SARS has over years, there used to be a huge discrepancy, first of all, between different rates of taxes that different taxpayers pay. For example, an individual, a company, a trust, a CC, and also huge differential between, you know, capital gains tax on an individual, a company, a trust, etc. They are bringing those rates very, very similar now to take away that arbitrage opportunity that people would do transactions in a specific entity for a tax purpose just to save tax. So a trust, although a trust pays tax, you know, at the highest bracket, you know, from Rand 1, I think that's the big difference, that they don't have the sliding scale like they have with individuals. You pay 45% from Rand 1. So it's the same marginal rate than individuals pay, but from Rand 1. Capital gains tax, because we got an 80% inclusion compared to a 40% inclusion for individuals. It is an effective tax rate of 36% in a trust versus 18% in an individual. So I think with all the differentials, and I wish I could show you the summary. I mean, I'm happy to send that through. But if you look at the effective tax rate, because it doesn't help to say, for example, a company only pays 28% income tax, but a trust pays 45%. You just remember the moment, or 27% income tax now, the moment you add dividend tax, it shoots it up. And the effective rate is now more. For example, if you sell a property in a company and you want to push that dividend up to the shareholder, it is now 21.8% effective capital gains tax rate in a company. The moment I add 20% dividends tax, it's shooting that rate over the 36% in a trust. So you can see why I'm always saying a trust is not the worst taxpayer, because of the rates that SARS is bringing them, pretty close now. Also, because we still have the conduit principle that I explained earlier, where we can take the tax liability in the trust and push it to beneficiaries, let them pay the tax at their individual tax rate, which may be zero because we got, the sliding scale. I think 82,000 or something is tax-free, is the tax thresholds for individuals now. So you can see each child could get, that amount tax-free, and from a capital gains tax perspective as well. So a trust is the highest taxpayer paying entity, but we can maneuver around. And, for property specifically, capital gains tax, it's even better to keep it in a trust than keeping it in the company if we just look at tax alone when we actually sell the property. Okay, next slide. Is there a difference in terms of transfer duty when buying a property in your personal name or a trust? So I want to say, you're the experts here with transfer duty, right? So all I want to say here is we need to be mindful. There is an impact on transfer duty. Obviously, transfer duty is payable on the acquisition of a property or a right to a property. A lot of people in the old days maneuvered and they sold their trust. So they had their primary residence in a trust, and now they sell the property by just changing the beneficiaries, changing the trustees. And that is, voila, new family owns the property and have beneficial use thereof. So SARS saw right through this, and in 2002, they made a change to the Transfer Duty Act and said, if you change trustees and you change beneficiaries, it will be deemed that you have disposed of the full property and it triggers transfer duty. So I am sure people don't do these things anymore because, it's a deemed sale. So it just makes no sense. Just sell the thing out of the trust and into a new trust or into individual's name, because it's going to trigger, those taxes. However, if you have set up a trust, and that is a benefit, again, a tax benefit. If you acquire a property in a trust and you distribute that property, no payment allowed. If you distribute that property to one or more beneficiaries, to the third degree of the founder, so sorry, it's a mouthful. So the founders, family members who got benefit, as beneficiaries to the third degree, transfer duty exempt, but it can't be sold out of the trust. It has to be transferred. So that triggers a couple of very important things to tick to make sure that in future, when we want to potentially transfer this house to or property to one of the beneficiaries, that the founder can no longer be the accountant or be the lawyer, right? Which a lot of lawyers and accountants and people who are setting up trusts, I call them the so-called professionals, make a massive mistake by putting themselves in as the founder. Our courts and the law says in South Africa, you can be the founder of a trust and a trustee of a trust and a beneficiary of the trust. You can't be the only founder, the only trustee, and the only beneficiary, but you can be. So a lot of people get advice, just don't be the founder because, it's going to be problematic later on. You're actually shooting yourself in the foot here, by not being able to access this transfer duty concession that we have here. So very important when we set up a trust that we set it up correctly, depending on the type of assets that we may hold, and make sure that the founder is a family member. And when we transfer a property potentially in the future to the third degree, we'll have a concession. As discussed, when we transfer a property out of from one family to another, and we just change trustees and beneficiaries, it's going to be problematic. So I think that's enough on there, Jan, unless you want to discuss something a little bit later. The difference in capital gains tax between an individual and a trust when a property is sold. We have discussed this. So when you look at a trust in isolation and we want to retain that capital gain in the trust, in other words, we're not going to distribute it to access the lower tax benefits, through the conduit principle, the trust will pay 36% capital gains tax. I just want to say on this level, sometimes people only look at the tax. Oh my word, I'm not going to pay 36% versus 18%. I mean, it's half the tax. I'm going to save tax by distributing to individual. For the estate planners and the estate administrators sitting there, it's the biggest mistake that people make. I've often run scenarios for people. It's not only about what tax I'm going to pay now. Just think one day ahead. If you die tomorrow, what have you done? You have distributed that capital gain to beneficiaries for them to access this beautiful half tax liability on the capital gain. However, what you have done, you've just passed assets into the estate of the beneficiary, because that distribution for the beneficiary to pay the tax is now an asset in the estate of that beneficiary. So if you die tomorrow, thanks for playing, 20% plus estate duty and executors fees. So it is not a simple calculation when you do tax calculations either. So don't at all costs, access this difference in the capital gains tax rate between individuals and trust, where you literally pay half, because if it was retained in a trust and the trust paid the capital gain at 36%, at least that's done. When somebody dies and the next day, no effect. And you can retain, it takes a lot of effort and a lot of years. And we know now with, the difficulty with Section 7C to get assets into a trust with this, new horrific tax, Section 7C, it's an effort to get assets into the trust. So you don't want to push it back into individuals' hands for them to pay the tax they're on, and then you've undone the entire estate duty or estate planning benefit by actually accumulating stuff in a trust. So again, it's not only about taxes, point number one. It's not only about taxes that I pay now. Just think one step ahead in terms of what about estate duty, by utilizing the conduit principle to push something into somebody's hands. So I hope this explains, it's not just about 36 versus 18%. It's about the other taxes that would trigger potentially by doing that. When buying or selling a property, do all the trustees have to agree to it? Okay. What did I say earlier? Go back to the trust deed. What does your constitutive charter say? There's nothing in law that tells us 1, 2, or 3, or all the trustees, have to agree. You look at the trust deed. We have concept of a minority or majority decision. In other words, not all trustees have to agree. Sometimes trust deeds say all transactions, trustees can rely on the majority vote. And again, don't think you're going to abuse this majority vote by excluding the minority. There are hundreds of court cases, and the courts are getting tired of the minority to be excluded deliberately. And people say, but I can use this majority decision clause in the trust deed. We don't need, these minority trustees' consent. Sorry for you. There's a case called the Lagrange case where the court said, all the trustees will be involved, regardless of what the trustees say. Because there's joint ownership, joint control, all the trustees have an equal say. You can't try and exclude somebody because your trust deed allows you to use the majority vote. All trustees have to be invited to the meeting to discuss whether this property is going to be sold. All the trustees have to participate and deliberate, and then you go over to voting. And if so, by the way, you have a majority provision in your trust deed and the majority outvotes the minority, then the minority has to live with the majority's vote. However, last step, then every trustee has to sign that resolution, regardless whether you voted for or against. So, because the majority decision may prevail, it does not mean that the minority, first of all, does not have to sign. They have to sign, but the minority can't use that as a veto right to say, I'm not going to sign this thing, because then it's not a valid decision. So can you see the interplay between, you can use the majority decision if the trustee allows for it. The minority can't use that as a veto to say, I'm not going to sign the resolution because then it's not a valid, then it's not a valid decision, or the sale wouldn't go through. What we normally do, because some people say to me, I voted against this decision because I truly believe it's a wrong decision. We shouldn't sell this property or buy this property. As I said, you can't use that as a veto mechanism. So what we normally say is to the majority trustees, just write a note there. Due process was followed in terms of the trust deed, because the trust deed may have very specific things. You have to give proper notice, days notice, make sure you follow the process. As long as you follow the process in the trust deed, you involved all the trustees in terms of what our courts require. And then you've gone over to voting, and there's not a unanimous vote. Either get everybody to sign. If there is one little line where somebody hasn't signed, don't just exclude them and say we've got the majority vote. If they refuse to sign, I normally just write there that we have followed due process. Here's the proof, then the transaction can literally go through. Okay, what is a resolution? Okay, resolution, as I said, the trust is run by a resolution. Every single decision in a trust has to actually be done by resolution. So that means something in writing, right? And then a lot of trust deeds allow round robin resolutions where we don't necessarily need a meeting to deliberate, etc. It allows for a resolution, and sometimes, or most instances, a trust deed say then that resolution has to be signed by all trustees. So if one trustee refuses to sign, it's obviously not going to happen. Then you have to revert back to your meeting to make sure that you follow due process, because trustees do sometimes not agree. And one needs to understand very clearly when we're having an invalid decision, which means the whole property transaction can fall flat, versus we have followed due process and we have an obstructive trustee who did not sign or did not want to sign that resolution. A power of attorney, there's a lot of court cases. You cannot, and I get so cross with the attorneys and the conveyancers and accountants and everybody and trustees even, who say, I've got a power of attorney, I can do what I want. Very broad. There is no such thing in law as abdicating responsibility to one or more trustees. As I say, a board is run by resolutions. I don't care whether you've got minority, majority, whatever. The document that outsiders rely on, for example, a seller or a buyer, is that resolution. And I want to make sure that resolution is watertight in terms of what we've just discussed here. Power of attorney, once the trustees have made a decision and then they empower one or more of the trustees to go and sign documents, probably the one that's attached, not you can sign whatever you want, whenever you want, because that may come back bite you. So you want to empower a trustee who to actually go and implement a trust decision. So I hope this answers this question. The next one, do all trustees have to sign a sale agreement? I think getting back to that, once all the trustees have agreed, the resolution is the starting point. The resolution and the trust deed. So by the way, if the trust deeds say all trustees have to sign, or Mr. X has to sign during his lifetime, then you have to abide by those. So that's why it's so important for any party, a party to a transaction in a trust. You have to make 100% sure you've got access to that trust deed and make sure the trustees have followed due process. There's this rule called the Turkwand rule, relied on with companies, where when I do a transaction with a company, I can assume internally all processes have been complied with, and the directors did what they were supposed to do. So I can rely on that. A trust does not have that. You can't assume that the trustees made that they have acted in terms of the trust deeds. So you have to make sure, unfortunately, every transaction that you do, you have to be the checker to say, yes, the trustees, this is a valid resolution that I'm relying on, or a valid agreement that I'm relying on based on a number of steps that had to be taken. So very easy for people to get out of transactions because due process, wasn't followed. So yeah, go back to your trust deed, go back to your resolution if trustees have discretion in terms of the trust deed, in terms of how many or who has to sign a sale agreement. Okay, next slide. What if one or more of the trustees refuse to sign such an agreement, or if he disagrees with the buying and selling a property? I think I've answered that one pretty well. You cannot use that as a veto right if you're the minority. However, if you have not been included in decisions, that decision is null and void if you refuse to sign it. You can't be, pushed to say sign it and, due process wasn't followed. but you can't use it as a veto right because you are the minority, right? And the trust deed may allow for the majority decision. Just on that point, I think the important transactions, as I call them, in a trust deed, when you set up a trust, I think you want to reserve some of the decisions, not to just be the majority decision. Some of these transactions, when it's important enough, such as buying a property or distributing a certain percent or over a certain percentage of the trust capital, you probably want all the trustees to agree. But again, this comes back to the relinquished control. So when you set up the trust, the founder has to realize, what he's signing up for. And if you reserving majority, remember, it's not just while the founder is alive. It's, once he's no longer around one day, and the children and the other trustees are involved, then you may want some of the decisions to be done by all trustees, not to have abuse of trust assets. So there's a fine balance between, well, this estate planner is alive and I don't want to relinquish control, and I don't want, everybody to agree. I actually don't want to do what I want, versus when you're no longer around. That's where we see the abuse, especially, things like such as this. Okay, the next slide. What is a trust deed and why is it so important to always know what is in the trust deed? Yes, your trust deed is your constitutive charter. Most people have never read the trust deed, so I have no idea how they know what they should be doing or should not be doing, because the trust deed can tell you very specifically what you are allowed to do, the powers, for example. If you don't have the power to buy a property in the trust deed, the trustees cannot buy a property. There's no common law right or power that trustees have. That's why normally when you look at the powers clause in the trust deed, that there are gazillions of things that are listed. They can buy property, they can sell property, they can improve property, they can lease property, they can rent or allow use of property by beneficiaries, even for free. You see, you have to be very specific when you buy a property and which type of a property, the estate plan envisages would be in the trust deed. And the trust deed needs to make provision, therefore, and allows you to put in there whatever you want. If you want to say, no free use of property, also, by the way, only free use of property. And I was busy with a R1 billion farm a couple of months ago, where it's now second generation and the brothers and sisters are in each other's hair. And they're very specific, in-laws, outlaws, who can have free use of a property and what rights do they have, to that property. So very important when you buy a property, your client buys a property in a trust, that you make sure that what the client thinks, you could do with that property is, stipulated in the trust deed. And a trust deed is tailorable. There's no such thing as a vanilla trust deed. So you can be super specific as to what can be done in a trust or not. Okay, going towards the end now. When a trust deed passes on, will it affect anything in the trust itself? So as I said earlier, that is one of the benefits of a trust, is it creates continuity. So whether a trustee passes away, obviously it may have the indirect impact, because you need to make sure the trust deed deals with replacement of trustees. A lot of the trust deeds are just not detailed enough, which may lead to very unintended consequences, because remember, trustees are the decision makers of a trust, over trust assets. They are the joint owners of those trust assets. So when you are planning a trust or setting up a trust, so important that you make sure the decision makers best you can, look forward to say this kind of a person, can be a trustee. This kind of a person can never be a trustee. I normally say the family trustees can appoint their follow-up trustees in terms of their wills to keep it in the family, because trust me, I've seen the so-called independent trustees who've abused trust assets to a large degree, and at some point, pushing out family members because the trust deed was just written so badly. So when a trustee passes on, it may have an indirect effect, but it's not going to freeze the assets or do anything. Same with beneficiaries, same with the founder. It's a separate entity that runs the next day as if nothing has changed. Okay, next slide. Questions?
Okay, Phia, thank you so much. What we'll do now is, let me just go to the chat. Right. How can the trust apply for bond if it's new? Does the trustees' affordability apply here?
Very good question. Remember, the banks want to know who is going to pay my bond. If we register a new trust, the bank is going to ask, where's the money going to come from? So therefore, they would potentially look at the, let's call them, broad terms, the estate planner, would look at the independent trustee to pay the bond, right? So it's going to follow that trail, show us, because remember, the banks now work on solvency. In other words, is the asset, so they're going to look at the loan to value ratio. Is their value to lend a certain amount? The second question they have to tick now for many, many years is liquidity. Where is the payments going to come from? So they would rely on one or more persons to settle that bond. So with a new trust, and I think it's become easier now over years. A couple of years ago, the banks were burned so badly, all of them were running for the hills when somebody wanted to raise funding in a trust. Sometimes the bank even loaded the interest rate because they said, it's higher risk now. But I really think if you have a relationship with a bank and you can demonstrate to them it's an estate planning tool that you're going to use, it's not something you're going to use to do them in with. They're probably going to place reliance on the estate planner or their client to settle the bond payments. Just then make very sure you follow due process, as we've explained with the FNB Brits case.
The following question is, would you suggest selling a company? I take it that selling the shares instead of selling the property to avoid transfer duty in the trust. Doesn't make 100% sure, but I'll just quickly mention it, that if you sell a company and there's a property registered, the simple answer is then there's transfer duty payable as well. You're missing the point if you're trying to do that. The next question, Ruth, if not all members won't sign, will the master make the decision on the sale? Members meaning the trustees. I think you've answered that in detail.
I think I'll just say the master is a post box. Don't get your hopes up that the master is going to do anything for you. They probably have 3 powers to remove trustees and appoint new trustees. Much of the time they say go and fight it out in court. So, yeah.
Right. What is the effect or implication if no account was kept or auditing not done on a yearly basis?
Well, that's why I say, a lot of the existing trusts who may, look to buy property now, you have to really question, are the affairs up to date? What is in the trust? Has tax returns been submitted? Did this thing have a bank account? A lot of trust, of the old trust, it says it will be audited every year. If it's not, hasn't been audited every year, you can understand what the cost is going to be just to bring that up to date. I think it just leaves holes to poke by SARS and creditors, including a soon-to-be ex-spouse, if things haven't been done properly, because then they may say this trust, it's just an extension of yourself, a term called an alter ego trust. So you know what, let's just disregard the trust, like the FNB case. Let's just disregard the trust and deal with the assets inside the trust. So be very mindful whether your trust deed has specific requirements as to does it have to be audited? Doesn't have to be audited? Do you have to do annual financials, etc.? So, and then it may cost a packet. We see a lot of trusts that for 20, 30 years, just nothing has been done. To bring all of that up to date, it's going to cost you a lot. And then I'm saying, was there a real intention to create a trust? So potentially, if it's an empty trust, it's dormant, like people call it, can it and register a new trust, because you're not doing yourself any favors by not having history up to date.
Thank you, Phia. The next question is from Bev Carrington. She's actually the reason why we're all together here. She came up with the idea that we have more info on trust. Thank you, Bev. Her question is, if an original old trust has a TM number, how then does handle IT number requirement now by banks? Okay, so TM is a testamentary trust. That obviously, the process when you register an estate with the master, there's 2 departments with the master. One is an estates department and one is a trust department. The trust department is the inter vivos trust, the IT inter vivos trust numbers. The TM numbers are testamentary trust numbers. That is, the estate would be what's the word now? Would be registered with the master. Then in that file is going to be the will, and
as I said, the trust is created in terms of the will, so it will stay with the estate section, and they give their number. So you get a TM number and an IT number.
There's no need to change the TM to IT because TM.
It would never. No, it is a TM number. Yeah, you get a TM number and an IT number.
Daryl, tax-related question. Company owns the holiday home. The company has a loan to the directors. Can the company transfer the shares to the trust without capital gain being activated? 2, can this sidestep Section 7C because the loan is in the company, not in the trust?
Daryl, SARS is far too clever for you. So obviously any disposal as defined by the Income Tax Act triggers capital gains tax. Whether I'm selling it to a trust, to a company, from a company, or trust to somebody else, it triggers capital gains tax because it's a disposal, and there's even things called deemed disposals. And then Section 7C, they've worked this out so cleverly, and it actually gets quite complicated because they knew that people are going to try and work around the direct loan to a trust. So now it includes direct loans to a trust, or loans to the companies, for the companies to make to the trust, or just to the company as held by the trust, or the company sits on money, and the estate planner says, company A, make a loan to the trust, on my insistence. So they covered all the ground. So Section 7C is a well thought out thing for any loans directly or indirectly to a trust structure, let me just call that. So whether it's to a company held by a trust or to a trust directly, it is caught in there.
Awesome, thank you. If there's anybody that wants to ask a question, just unmute yourself and then ask the question. In the meantime, while we're waiting for anybody to ask a question, you can see on your screen Phia's detail. Please take that down. If you want to send an email or visit the website, telephone number, you're welcome to do that.